Welcome back to the Real Estate Investing Guide Pre-Offer Due Diligence series. Thanks for joining us. If you like the video, be sure to like and subscribe to the channel so you can be alerted whenever we put out new real estate content. Also be sure to watch our other real estate investing guide that pertains to post-offer due diligence you will not want to miss. Chapter 3. Conduct financial analysis. Once a buyer understands the area and the seller disclosures, they can then conduct a basic real estate financial analysis. This will help the investor better understand return on investment and if the projections match against their expectations, and allow them to compare the deal to other potential investments. Section 1. Income analysis. 1. Gross rent, total rent, multiplier or GRM. GRM equals total purchase price, total annual rent. The lower the number, the better the property is at producing income. For example, a property with a $500K purchase price and $50K annual rent would be a GRM of 10. A property with a purchase price of $900K and annual rent of $75K would be a GRM of 12. The deal with the GRM of 10 would be preferable. 2. 1% rule. The 1% rule is a basic measurement where the monthly gross rent should be equal to or greater than 1% of the total purchase price. For example, a property priced at $330K has a monthly gross rent of $2,800. $2,800, $330,000 by 0.01 equals 0.84. 0.84 less than 1 and therefore does not meet the 1% rule. Buyers can use this basic calculation to determine if a deal should be investigated for further analysis. 3. Capitalization rate. Cap rate equals NOI, net operating income, purchase price. Total annual rent minus all operating expenses, not including debt payment, purchase price. The higher the cap rate, the better the ability of a property to produce income. For example, a property produces annual NOI of $18,000 and the purchase price is $220K. $18,000 divided by $220,000 equals 8.18% cap rate. For example, a property produces annual NOI of $25,000 and the purchase price is $420,000. $25,000 divided by $420,000 equals 5.9% cap rate. The cap rate is important because it represents the opportunity costs associated with making a real estate investment compared to other investment vehicles. 4. NIAF, net income after financing. NOI, financing costs. This calculation displays roughly how much money will be left over after the debt is serviced. Again, the higher the number, the better investment a property might be. For example, an 8-unit building produces $7,000 monthly and has a mortgage of $4,000 per month. $7,000 $4,000 equals $3,000 NIAF per month or $375 per door. Costs of debt finance can be calculated by using a mortgage calculator. You would simply plug in the purchase price, the down payment amount, and the interest rate, and any mortgage calculator would give you the cost of debt service on a monthly basis. 5. Cash on cash return. This calculation helps to determine the return on investment regarding the total amount of cash it takes for the investor to enter the deal. This amount goes beyond the down payment amount and should include all costs, including expected costs of repairs and any closing costs. Again, the higher the number here, the better. This again is why it is important to understand the costs of repairs. If costs are underestimated, the cash-on-cash return will look higher than what it will be in reality, and therefore look like a better return on investment than the deal is actually capable of producing. So going off the last example, suppose a property has a NIAF of $3,000 per month or $36,000 annually. The deal requires the buyer to put a total amount of $280,000 down. $36,000 divided by $280,000 equals 12.85% cash on cash return. This calculation may also be misleading if a buyer is using more debt to finance the purchase and only uses a small % of money to enter the deal. Therefore, multiple calculations should be used to better understand the overall assumed benefit of the revenue capability of a property. Section 2. Equity. Sometimes opportunities may be present within a potential investment property by identifying ways additional equity can be gained. Can additional equity be achieved by purchasing the property at a price below asking price or below the ARV, actual retail value? Can you make low-cost improvements to increase the ARV and force equity through those improvements? Can equity in this property expect to increase faster than other properties? Again, a lot of this comes down to location, as properties in better areas tend to experience faster appreciation than those properties in less desirable areas. Thank you so much for joining us. Be sure to watch our next video in Chapter 4, Check Public Records. Also check out Chapter 8, Obtain Financials, in our other Real Estate Investing Guide Post-Offer Due Diligence series. For more financial calculations you will want to make sure to verify. Be sure to contact us for all your Twin Cities real estate needs. We offer no-cost initial consultations, and we'd love the chance to earn your business. LakerRealEstate.com 763-645-4617